are joined by a man who has just returned from a tour around 4 of the country's most important cities. He is Louis Wan. He's Chief Investment Officer at Pride Investment Group, and he joins us now live from Hong Kong. Good morning to you, sir. So tell us about your trip. What did you find out about China's property market?
Yes, I just got back from a trip to Beijing, Shanghai, Qingdao, and Weihai, and I got 2 key observations I may want to share with you all. The first observation is in relation to the property market in China. Right now, we understand that the government used a lot of policies on tightening up the credit to the fixed asset investments, especially on the property sectors. That is so we think that it is very difficult for the developers to get the new lending in the coming years. For the demand for the property markets, it varies among regions. For example, for the tier one cities like Beijing and Shanghai, the demand for properties is very, very low, waiting for a correction and then buy in. That means the government. That means the mass public still want to buy more at the level which is if the market have some corrections. And for the tier 2 and tier 3 cities, like for the tier 2 cities like Qingdao and Weihai as an example of the tier 3 cities, the demand for the property markets is very, very strong regardless of the property price. That is my that is the first observation. And my second observation is in relation to the bank loans. We believe that the 7.5 trillion RMB new lending for this year can be achieved, given that there's a lot of infrastructure projects kicked off last year's. New lending is still required for the completion of these projects.
Well, it's obviously a very hot market, a lot of demand for these properties, a lot of demand for loans. The government is trying to cool that down. But tell me about local governments and their borrowing. This is something that the government started to talk about more recently. Local governments have been borrowing a lot of money, building a lot of infrastructure. Are you concerned that we could see bad loans coming from that department?
Right now, we don't see that's a huge problem for the bad loans. We believe that most of the projects that is kicked off last year or the new lendings last year's will not gone bad in a very short period of time. We're still thinking of it may take about 3 to 5 years to have the new lending to be bad. But right now, from our understanding, most of the lendings granted last year's is mainly in relation to the government-supported projects, infrastructure projects. For that kind of projects, it is difficult to be bad debt within a short period of time. I would say that.
Okay, thanks very much. Louis Wan, Chief Investment Officer there of Pride Investment Group.